Hello and welcome to the latest investment market update. I hope you're all keeping well. I'm Brian Morman, Chairman of Brunsdon Financial, and today I'm being joined once again by Mark Shields, Investment Director at Brooks Macdonald. Brooks Macdonald have been carefully selected to manage the Brunsdon investment funds, and using their expertise, the team analyse movements within the market and make tactical changes. There have been quite a few changes recently. Firstly, a new president and administration to come in the USA. Mark, what implications do you foresee up ahead?
Hi, Brian. Yeah, we see a few sort of fairly significant implications for the election of Donald Trump. We've already seen equity markets in the US rally bounce quite strongly off the back of his victory. Conversely, we've already seen the yields on US debt rise quite a bit as well, and obviously prices move inversely to those yield increases. So essentially, the value of US debt has fallen. We suspect that at least in the near term, this may well be a trend that could continue. We feel that equity markets in the US will probably quite enjoy the fact that Donald Trump is all about sort of deregulation, low taxes, and essentially sort of trying to hobble some of the competitors in one way or another. Also, we feel that quite a lot of his measures that he's talking about introducing, such as clamping down on immigration, fairly significant tariffs, these are all likely to be inflationary. And therefore, we sort of suspect that we may continue to see those inflation numbers from the US at least, maybe not fall as fast as would otherwise have been the case. Indeed, we may see another inflationary spike, depends on how far he goes. But in either case, we suspect that at least in the near term, pressure will remain on the US bond market, specifically the US Treasury market. Longer term, this may be several years away, we don't really know. We do have some slight concerns over the picture for the US debt situation, but I don't think that's something that the markets are going to be factoring in quite yet. But it might be something that we need to keep an eye on for, maybe a year or two out, especially if Donald Trump does go on a big spending spree without kind of raising taxes in a corresponding way. In terms of how this has impacted our portfolios, well, certainly, both the Adventurous and the Cautious Fund have very much benefited from their US positions. Certainly the Adventurous Fund has benefited from its US smaller company exposure. That's done very, very well recently. Whilst the Cautious Fund has benefited from the fact that it has much greater degree of exposure to short duration, i.e. defensive bond positioning, than the market, and therefore has benefited on a relative basis like that. So whilst we do have some positions in parts of the portfolio that have struggled, such as decarbonisation as a theme, in aggregate, both the funds have performed relatively well off the back of a victory for Trump, at least in the near term.
Thanks, Mark. Now let's turn to the October budget in the UK. Some very significant changes are up ahead. What thoughts have you got for the UK?
Yeah, I think the budget itself was a bit of a mixed bag. Obviously, it was good that we didn't have a Liz Truss type blowout in the bond market. We have seen yields on UK debt trend up a little bit, but I think that's largely following the market rather than anything specific to the UK. There's an argument that may not be the case, but at the moment that seems to be what we're seeing. So we did avoid a bit of a sort of blow up sort of type scenario. However, I think quite a few of the areas they chose to target with regards to their tax rises, specifically national insurance and corporations, etc., could well be detrimental to the UK market in the near to medium term. So, we do think it was a bit of a mixed bag. I think they probably could have raised sufficient taxes without targeting corporations so aggressively. They could have looked more at the sin taxes. They could have looked at changes to pension funds. They could have looked at CGT and IHT in more kind of precise ways. And I sort of do think that the wealthier members of society should be paying more. However, I do sort of think that, essentially treating corporations as a bit of a piggy bank is not really the right approach to grow an economy. So I have slightly mixed feelings about it. In terms of our portfolio, obviously we do have a bit of UK exposure. The majority of our UK exposure is concentrated at the large cap end. That has been reasonably resilient, but it definitely has not performed as well as the US, for example. Smaller companies performed very well in the immediate aftermath of the budget, largely because I think there's quite a bit of pressure on areas such as AIM, because people expected there to be much more of a tax impact on AIM that didn't materialize. But again, we haven't really seen that sort of sustained recovery post-budget that we would have liked to have seen within UK assets at this point in time.
Thanks, Mark. Lastly, let's look at the continuation of de-globalisation. How do you see this affecting investment markets and in particular the BAM funds?
Yeah, we definitely have seen a bit of a trend of de-globalisation post-COVID. We have certainly seen, quite a lot of companies talking about onboarding or onshoring various activities. The reality is that it's actually, I think, been quite a bit harder for companies to do that than maybe they've anticipated. And therefore, I would be a little bit reluctant to sort of call the death of globalization at this point in time. Obviously, the much more recent development has been, or is potentially going to be, the Trump effect, as it were. And if he is successful in delivering a lot of the tariffs that he wants to do on various trading partners, not least places like China, then it may well become much more in companies' self-interest to onshore various activities where and when they can. So it is a trend that we have seen. As to whether it's something that is going to continue would probably be very much dictated by the measures and policies that Trump chooses to enact, as to whether we see this accelerate or maybe even decelerate somewhat. In terms of the effect on the portfolios, we haven't seen a huge amount thus far, but clearly, we have slightly moved away from some of the areas that are most exposed to this deglobalization kind of concept, such as China, emerging markets, and it may well lead to a renewed focus on large markets such as the US.
Okay, thank you, Mark, and thank you for listening. As always, if you have any questions or queries, please be in touch. Thank you.